Hey, what's going on, everybody? It's Saturday. I just walked up 45 flights of stairs as training for my Grand Canyon hike next month. Hey, last week was an interesting week. You know, I've been doing this a long time, folks. Been trading in the markets. And sometimes I just like to sit back and watch. And it's kind of humorous and it's kind of funny when I see these Wall Street analysts and these Wall Street people and the financial media talking about stuff, and especially economists. You know, economists, they like to put all these fancy terms on things, like almost to try to make what they're doing a little bit more scientific. Economics is not a hard science, it's really a social science, but don't tell that to mainstream economists, because they will argue vociferously that economics is a hard science like physics or mathematics. And as a matter of fact, there are branches of economics or focuses of economics that are highly mathematical, but they're useless when it comes to forecasting or anything else. So one of the terms that economists like to use, and that's also used a lot on Wall Street, is a term called the reaction function. Sounds fancy, right? And the reaction function is often used in conjunction with the bond market and the central bank. And it is a term used to describe how, it is a term used to describe the expected behavior of investors when the central bank does something or is intended to do something or is expected to do something. So last week it blew up, the reaction function blew up last week, because up until last week, as you know, because I'm sure you've been following it and I've been talking about it, you know, we saw that February, March rally in bond yields, bond yields going up and everybody hyperventilating about inflation or hyperinflation and the stimulus. Now I kept saying, look, the Fed is not raising interest rates. The Fed sets the interest rate, and the Fed sets the interest rate all along the term structure by virtue of, how long they intend to sit at a particular rate, or if they're raising or if they're lowering rates. I've said this over and over, that the rate anywhere along the term structure is a reflection of Fed policy over that term. And the Fed just keeps saying, hey, we're not going to raise rates. First it was we're not going to raise rates till 2022. Then it was not going to raise rates until 2023. Now it's not going to raise rates until 2024. So, they're telling you this. Not to mention the fact that when you look all over the world, rates are basically at zero in the major economies. And even in some cases, they're negative. All right? Like Japan is negative. The Euro zone is negative. So, the Fed was telling everybody, but yet all this, big fancy talk about the reaction function. So what happened? We started to see bond yields come down even before last week, but last week was when the whole function blew up, because we saw a gigantic increase in retail sales. What was it? It was up something like, it was almost a 30% increase year over year, like a 10% increase. It was historic. It was never up that much. 48 billion, I think, in 1 month, something like that was the change. We saw big numbers everywhere. In the Philly Fed Index, we saw a huge drop in weekly unemployment claims. What was it, down like 196,000 or something like that? It was the biggest drop in 8 months. And bond yields came down. And bonds had a huge rally. And all of a sudden, all these Wall Street geniuses were scrambling to try to figure out what the heck happened to the reaction function. And the brilliant explanation they came up with was, I guess the reaction function changed now. And it's only reflecting that the stimulus is not going to be that big anymore because the economy is rebounding on its own. So, I mean, when I see stuff like this, I just got to sit back and laugh. I just got to, because, it must be really, really hard to, go through these contortions all the time to try to explain something that is obviously inapplicable or wrong. I mean, the effort and the energy involved, you got to give these guys credit just from, the expenditure of effort to try to reframe it all the time to make something that's so obviously not fitting to their theories fit into their theories. I mean, it's like you got to be a contortionist. You got to be some kind of a mental contortionist. And I mean, I look at it, it's entertaining. It's entertaining. Because the explanation is really very simple. The central bank sets the rate and it's telling you, we're not changing the rates. We're keeping them down. And then, of course, beyond that, which is another thing I've been talking about the whole time, is that the price increases, which have been kind of narrow, they've been, lumber, we saw it up, some metals, stuff like that. Gasoline, energy, gasoline's what? Average price of gasoline here is like what, $2.50, $2.58, $2.60 a gallon? I mean, I remember back in 2007, it was like way over $4. Everyone was doing a staycation. Remember that term? Because you couldn't afford to put gas in your car? So the pandemic has caused these supply disruptions. We're seeing some of these problems start to go away, start to fade away. But the most important factor of all is that the central bank, the Fed, is saying, hey, we're not raising interest rates. Hello, everybody. We're not raising interest rates. But all these geniuses on Wall Street, contorting, twisting in the wind, trying to come up with a way to, explain what they thought was going to happen but didn't happen, but yet bring that back somehow into their, comfortable little definition or explanation. Folks, it's hilarious. It's comical. I mean, if you can't take money from these guys, they're literally handing you their money. And they're doing it in a way where they're entertaining you at the same time. I mean, how much better can it get? It can't. Now, you could choose to be one of them. That's no problem. There are lots of people who choose to go. But me, I prefer to sit back, enjoy the show, and take the money. Have a great rest of the day, everybody. I'll see you tomorrow. Bye-bye.